Hi, welcome back. This is my 13th update on the crisis. And over the last 6 months, to give you a sense of how my perspective has shifted about this crisis, I want to focus on the title that I've given these updates. Early in the crisis, February 26th, for instance, the very first post I called a viral market meltdown, reflecting the fact that stocks had melted down over the previous 2 weeks. In fact, my first 6 updates were all titled viral market meltdowns, reflecting the collapse in equity prices around the world. Now, somewhere in early April, I recognized that that name did not fit anymore as markets started to come back. In fact, my last 6 posts have been titled a viral market update. And maybe I should call it a market comeback, because that's really what's happened over the last 6 months. After those 6 weeks of losses, stocks have recouped all of those losses pretty much around the globe. But that comeback has not been uniform. There's been a reallocation of wealth that's occurred, and I've chronicled how that shift has happened in my last few posts. Capital-intensive businesses have lost out to capital-light businesses. Debt-laden businesses have lost out to business without debt. Flexible businesses have gained at the expense of rigid businesses. But in this post, I want to focus on 6 companies. And you can probably already guess which 6. The first 4 are the FANG stocks: Facebook, Amazon, Netflix, and Google. I still call it Google, even though its name is Alphabet. And I add to that list Apple and Microsoft. Why those 6 companies? Because without those 6 companies, there would be no comeback to talk about. Not just over the last 6 months, but over the last decade. These 6 companies clearly dominate the market, and it's time to take a closer look at them. Before I do that, though, let me do my usual survey. Let's start by looking at what stocks and bonds and other asset classes have done over this crisis. I'll start with equity indices. In this table, I have a selection of indices, not a complete listing, geographically spread out, and you can see with every single index the same pattern. Between February 14th and March 20th, it's unmitigated damage, 30%, 35%. Then you see a comeback. And some indices have come back almost completely, like the S&P 500. Some have more than come back, like the Nasdaq is now up. Some are still below where they were before the crisis started. But these are all returns in local currency terms. I'll come back and take a closer look at equities by region. But let's take a look at Treasuries during the same period. In the first 5 or 6 weeks, as stocks were melting down, money flowed into the Treasury markets. Treasury yields dropped, and they've stayed low. The 3-month yield is now close to 0%. The 10-year yield is well below 1%. And even the 30-year yield is 1.2, 1.3, 1.4%, well below what it was at the start of this crisis. You think that's easy to explain? The Fed did it. Remember, the Fed itself did not act till March 15th. And much of the drop in Treasury rates happened before then. It is true on March 23rd. The Fed followed up with a second announcement where it said it was going to be a backstop in the private lending market. Didn't do much for Treasuries, right? But it did turn the corporate bond market around. In what sense? This is a graph of corporate default spreads. And you can see that in the first 5 or 6 weeks, while stocks were melting down and money was flowing into Treasuries, default spreads were widening in the corporate markets. In fact, the BBB rated bond spread went from almost tripled between February 14th and March 20th. But once the Fed made its announcement on March 23rd, you see the turnaround. Default spreads have dropped off. In fact, at the highest ratings classes, default spreads are almost back to where they were on February 14th. At the lower ratings classes, they've come down, but they remain above where they were on February 14th. The corporate bond market has had a turnaround. Now, I've tracked 2 commodities during this crisis, oil and copper, both economically sensitive. In the first 5 or 6 weeks, they were punished. Copper was down 15%. But if you look at oil, it was down more than 50%. Now, both commodities have come back. Copper has made it back completely, and it's now up relative to where it was on February 14th. That says something about what investors think about the global economy. Oil is back, but not completely. It's still down 20% from its February 14th levels, but that's quite a recovery from its low point at the end of March. Now, looking at gold and Bitcoin, you see the same phenomena play out. Gold has played its role as a crisis asset. It's held its value through much of the last 6 months. It's up about 22% over the entire period. Bitcoin is up 14%, but that's a little deceptive. Because if you look at how it got there, it's tracked stocks. In the first 5 or 6 weeks, Bitcoin collapsed. It behaved a lot like risky stocks. And since then, it's come back just like stocks have. Bitcoin has not behaved like a crisis asset, at least during this crisis. That could change in the future, but something to file away. Now, at the end of every week, as you know, I've been collecting data on individual companies and slicing and dicing the data by region, by sector, by industry. And there's some familiar findings here. If you look at the returns by region and you look at the cumulative damage across the regions, the 3 worst hurt regions of the world are emerging markets: Africa, Eastern Europe and Russia, and Latin America. In fact, if you look at if you look at global stocks collectively, they're almost back to where they were at the start of this crisis. But they've had quite a climb back. In the first 5 weeks of this crisis, global stocks lost $26 trillion in market cap, and they've made it almost all the way back. That's quite a comeback. So if you look across regions, parts of the world that are still worse off than they were before the crisis, and parts that have made it almost all the way back. If you look across sectors again, you can see the damage is disparate. In fact, if you look at the last column, you can see there are 6 sectors where the numbers are green, which means that the market caps of the companies in the sector are now higher than they were before the crisis. So if you look at those sectors, they tend to be capital light. Technology is in fact the best performing sector in the market. If you look at the red numbers, those are still the sectors that are showing damage. There's energy, no surprise there. Oil is down. You also, on top of that, have real estate and utilities, 2 big infrastructure businesses. You're saying, what do those 3, energy, infrastructure, and real estate, share in common? Or energy, utilities, and real estate share in common? It's not just the infrastructure investment, it's the fact that they use debt to fund that investment. And if you look at the worst affected sector, it's banks. Why? Because they're the ones who will be left holding the bag if these companies are unable to meet their debt obligations. If you look at the best performing and the worst performing industries, more of the same. The worst performing industries are big infrastructure businesses, often with substantial debt, with a few financial service businesses thrown in there. The best performing businesses tend to be capital light businesses, technology and healthcare. So no surprises, and you can see why I describe this crisis as the most orderly crisis I've seen in my lifetime, because the damage and the rewards seem to make sense. Now let's turn our attention to the FANGAM stocks. Now we act like these stocks have been around forever, but they're all relatively young companies. The 2 oldest obviously are Apple and Microsoft. They've been around since the 1970s. Google, Netflix, and Amazon all were founded in the 1990s. And Facebook, of course, was founded in 2004. I've listed out the IPO date, and you can see the market caps that they had at the time of their public offerings. Facebook is by far the biggest company at the time of its public offering, with a rough estimated market cap of $80 billion. But Google at $23 billion was viewed as a really big IPO at the time that it happened. In contrast, we look at Apple and Microsoft, which were viewed as big IPOs at the time they happened in the 1980s. They're relatively small companies. Amazon and Netflix started small. $438 million for Amazon, $300 million for Netflix. But I've also tracked milestones, how quickly these companies got to $100 billion. Google took almost no time. But for a company like, if you look at companies like Apple and Microsoft, it took a long time. Apple, it took almost 21 years to get to $100 billion. From 100 to 500 billion, and you can see 5 of these 6 companies have made that. From 500 billion to $1 trillion, and 4 of these companies have made it. And 2 days ago, Apple crossed the $2 trillion mark. I've also listed out revenues that these companies had 20 years ago, 10 years ago, and last year. And you can see that these companies have grown tremendously over the last 20 years. There's a basis for the increase in market cap. Now, as many of you know, I'm a great believer in using a corporate life cycle to explain how companies behave, arguing that as companies go from young to old, you can see their emphasis shift from investing to financing to dividends. And the focus of the company also shifts. And I find this a very useful mechanism to explain why companies face the problems that they often do, given where they are in the life cycle. Now, the 6 stocks I listed are in a sense the exceptions to the corporate life cycle rule, because for better or worse, they seem to have found a magic pill to keep from getting old. Let's take Amazon. Amazon started in the 1990s, rode the dot-com boom, then almost went bust with the dot-com bust, and got back to growing as an online retailer, disrupted the retail business, but by 2010, it looked like the growth was running its course. Many people were rating Amazon for a mature company status. Not a bad status, margins would go up, growth would come down, but Amazon reinvented itself. It reinvented itself from a retail firm to a disruption platform. What does that mean? Well, the way I see Amazon in the last decade, they've essentially said, look, we're not in any business in particular. We can be in any business we want if we feel we can make a difference there. They target inefficient businesses and take advantage of them. That's kind of expanded the story. Apple and Microsoft looked like they were old companies, and then they found a way to reincarnate themselves. For Apple, this happened towards the end of the 1990s. Given up for dead, it came back. It came back, of course, with the iPad, the iPhone, and not quite the iWatch, but the iPad and the iPhone made a huge difference. Microsoft stayed on course to being an aging company almost into the last decade. In fact, until 2013, the only two successful hits Microsoft had ever had were Windows and Office. And then Microsoft too reincarnated itself, primarily by discovering the cloud business. So Apple and Microsoft, if you are posing examples of reincarnation, would be perfect examples. Alphabet and Facebook have always been online advertising companies. But here's what's different about them. As they've gotten bigger, they've found it easier to get even bigger. So not only have they dominated online advertising, they've increased their dominance. And they've also pushed the extents of the market. So these are companies that initially looked like they'd run into a brick wall, but have found a way to keep expanding the markets they're in, continuing to maintain growth even as they scale up. And Netflix is what I call my shape-shifting company. This is a company that has gone through tests. Early on, it started as a DVD rental company, competing against Blockbuster, and then made a transition to a streaming company where it rented other people's content, signed up subscribers and streamed it to them. And then when they got squeezed by those content providers, it became a content producer on its own. Today, Netflix is the largest spender on entertainment content of any company in the world. It's a company that's managed to shift with the times and each time come out ahead. So interesting, because these six companies are often viewed as exceptions to the rule, but remember, we need exceptions for the rules to exist. So let's go back to January 2010. Because even though today it seems almost destined that these companies were going to dominate the last decade, it wasn't always so. In January 2010, if you'd looked at these six companies, here's what you'd have seen. You'd have looked at Microsoft, and your reaction would have been, this is a giant, but it's a lagging giant. It was the second largest market cap company in the world, with a market cap in excess of $270 billion. But remember, this was a company that 10 years earlier had a market cap of $500 billion. So it was a come down for Microsoft, and people were convinced that growth was going to lag, was essentially going to slacken, and the company was going to become an aging company. Apple was already a rising star in 2010. It had kind of found its reincarnation, increased its market cap to $200 billion, and was well on its way to becoming the superstar company. So Microsoft was descending, Apple was ascending. Amazon I've always described as my Field of Dreams company. In 2010, it lived up to its name. Field of Dreams company, why? Because through its life, Amazon said, look, if we build it, revenues, they will come, the profits will come. And markets had trusted them, and they continued to trust them. But it looked like Amazon's retail growth, at least, was running into a limit. It was becoming a large retail company. And as I said, people were readying it to become a more mature company. Google was the prototype for tech companies. It had gone public in 2004, and by 2010, it was well on its way to becoming one of the larger market cap companies in the world. Speeded up growth. Now, Netflix was very much in the cusp. I'd seriously doubt that anybody would have put Netflix in the list of the 10 biggest winners of the next decade in terms of market cap. It's a company that was a successful company, but people consider it to be a small successful company. And Facebook was not a public company yet. It was a private company that was attracting attention. VCs had already priced the company at $17 billion. There was talk about an IPO. What I'm trying to say is in hindsight, it seems these 6 companies were bound together. But in early 2010, I dare you to find one mention of FANG stocks. There's a bit of revisionist history here when we bundle these companies together. They're together because they've been so successful. But that said, clearly they've dominated the last decade. And one graph alone will tell you how much they've dominated. This graph, what I've done is I've looked at the change in market cap of the 6 companies, the FANGAM stocks I listed, and for the rest of US equities, which is almost 7,000 companies. Over the last decade, 2010 through 2019, almost 20%, 1 in 5 market cap dollars created in the market came from these 6 companies. Think about it. 6 companies accounted for 20% increase in market capitalization of all US equities. You know how this showed up? Those 6 stocks that I listed increased in value from about 6% of the overall market cap of all US stocks at the start of 2010 to 15% by the start of 2020. The last decade clearly belonged to these 6 companies. Now, as these companies rode the wave and increased market cap, and you get to the start of 2020, there were many people out there with doubts about whether they could keep doing it, especially among the value investing crowd, because these 6 stocks symbolized everything that value investors hate. They're driven by growth and momentum. Even though one legendary value investor, Warren Buffett, did own one of the stocks, these were not stocks that made value investing lists. And in fact, between January 1st and February 14th, these stocks continued to rise. And by February 14th, these stocks accounted for about 16% of the market cap of all US stocks. Remember, February 14th is the start of the crisis. The crisis hits. And one of the big questions was, is this the crisis that's going to untangle, bring these 6 companies back down? Well, to answer that question, I tracked these 6 companies over the last 6 months. So what I've done each week is I've looked at the market cap of these 6 companies, the market cap of the rest of US equities. Let's start with the bad news. In the first 5 weeks, these 6 companies lost $1.4 trillion in market cap. But here's the telling number. While they were losing 1.4 trillion, they were increasing as a percentage of the market from 16% to about 17%. Why? Because the rest of the market was down even more. Since March 20th, not only have stocks come back, but these 6 stocks have come back even more. They've not only recouped their original losses, but they're now up $1.3 trillion relative to their values on February 14th. In fact, by August 14th of 2020, these 6 stocks accounted for 20% of the market cap of all US stocks. I know all good things eventually come to an end, but if you're waiting for this crisis to be the end of these 6 stocks, clearly it's not been so. So I started thinking about what these companies share in common, because they are a pretty diverse group if you think about it. Netflix is an entertainment company. Amazon is a logistics retail company. Facebook and Google are advertising companies. Apple is a smartphone company, and Microsoft is primarily a software company. What do they share in common? I see 3 things that bind these 3 companies together. The first is each company has at least one business that's a cash machine. With Apple, it's the iPhone. With Microsoft, it's not just Windows and Office, which are cash machines, but you also have the cloud business as a cash machine. With Facebook and Google, their basic business, online advertising, is a high profit margin, large cash generating business. Netflix, which is the weakest of the companies in this group, has a subscription base that's sticky. Remember, the typical Netflix subscriber stays on month after month and pays in. Amazon used to be a company without a cash business in its midst, but even Amazon's found the cloud business. AWS, which is Amazon's cloud business, is a hugely profitable cash business for Amazon. So all of these companies have a cash machine. You're saying, so what? That cash machine generates profits and cash flows. It's allowed these companies, for the most part, to stay lightly levered. They have very little debt relative to their market values and what they can generate as cash flows. And they have huge cash balances. Second, every one of these companies has a huge user base. Facebook, of course, has 2.7 billion users, many of whom are in its ecosystem for extended periods every day. Microsoft, Google, and Apple have at least a billion, probably more, in their ecosystem, entangling them in one of their many devices. Amazon, Netflix might not have billions, but they have hundreds of millions of users who are interacting with these companies on a regular basis. And while they're interacting with these companies, the companies are collecting data. Now, don't get all indignant on me. I mean, we're giving them the data. And these companies truly give big data the name it should have. Most companies, when they talk about big data, my tendency is to yawn, because what they're calling big data is neither big nor usable. But for these companies, big data is actually a true competitive edge for two reasons. One is the data they collect is proprietary. It's exclusive. Only they have the data. So what Amazon finds out about your shopping, and what Netflix finds out about your watching habits, or Google about your search history, only they know. Second, they can take the data and they can act on it. Google and Facebook, of course, take the data and make it the basis for their advertising business. No, but it's more than that. Amazon tailors what you see on the shopping page to your shopping history, and Netflix makes movies based upon what you watched before. So those are the three characteristics that these companies seem to have in common. And during this crisis, they've allowed these companies to become stronger. And think about why. The fact that they're cash machines allows these companies to be insulated against the kinds of worries that their competitors face. If you take Amazon, their brick and mortar retail competition is not doing well. For the most part, many of these companies are highly levered, don't have the earnings and cash flows to get through this crisis, and they worry about making it. Amazon doesn't. And that's true for every one of these 6 companies. Second, because we're homebound, we're more dependent than ever on these companies to keep us going through the day. Just last week, as an experiment, I took every waking hour of the day and I looked to see whether I was in one of these companies' ecosystems. And guess what I saw? I found out of the 16 and a half hours I was awake that day, for all but 30 minutes, I was in one or more of these companies' ecosystems, Apple or Netflix or Amazon. This crisis has made us even more dependent on these companies, and we're giving them more data every day. So it shouldn't surprise us that these companies have done so well during this crisis. In a strange way, that success might be the biggest risk that you see in these companies, because it's creating some pushback, legal and regulatory pushback. With Facebook and Google, it's already taken the form. Privacy restrictions the EU has passed, but they're also now part of a political debate and whether their platform should be controlled. Amazon has always had critics because it's wiped out so many competitors. But now you're hearing them get louder and arguing that maybe antitrust laws should be used to bring Amazon back down to earth. Apple has catered, often been under the radar, but even Apple's now in the news in bad ways, especially last week when they banned Fortnite, one of the most popular games in the world, from being on the App Store because they broke Apple's rules. And let's face it, Apple takes a hefty slice of every dollar of revenues you collect as an app maker on their stores. In fact, what I find funny is that Microsoft is viewed as the most virtuous of these 6 companies. In fact, it is, you probably already know this, Microsoft is the most widely held stock among ESG funds, socially responsible funds. I find that funny because I'm old enough to remember when Microsoft was the Darth Vader of technology. And in 2000, the Justice Department wanted to break up Microsoft because they viewed it as a monopoly. But I guess the wheel turns. But if I were investing in these companies, that possibility with a regulatory or legal pushback has become very real. So here's what I did. I decided to value each of these six companies. Now, before I show you my valuations, let me be very clear. These are my stories, my valuations. You're welcome to disagree. In fact, I encourage you to disagree. I have the spreadsheets out there. You can click on them, change the parts of the story you don't agree with, come up with your own valuations. But for better or worse, here's what I saw in the 6 companies. First, perhaps not surprisingly to you, I found only one of the 6 to be undervalued, and it was Facebook. 2 were mildly overvalued. Google and Netflix, overvalued by less than 10%. 2 were significantly overvalued, Amazon and Microsoft. And my most overvalued stock was Apple. Now, just in the interest of honesty, I have to tell you that I own 3 of these companies coming into this analysis. I owned Facebook, I owned Apple, and I owned Microsoft. So after I did this analysis, here's what I decided to do. I sold my Apple, and I did it reluctantly. The stock has been good for me. I bought it around in 2017. Stock was around 75. Now it's done. So from that perspective, I have nothing to complain about. But to me, given the market cap today, the stock looks much too overvalued to be in my portfolio. I bought Microsoft even longer ago, to 2013. It's done even better for me than Apple has. And while it's overvalued, I continue to hold it. And while you might view that as being not quite consistent, I'll explain why. It's overvalued, but if I think about the capital gains taxes I would have to pay if I sold the shares, and the fact that I will probably buy Microsoft at some point in time in the future, I'm going to continue to hold it, but I'm going to watch it. If it continues to keep going up, then I might have to do to Microsoft what I did with Apple. With Facebook, I already own it, and I'm glad I own it. I'm not going to double down and increase my holding. I'm going to stay with my holding. Google and Netflix are now on my watch list. Why? Because they're close enough to being fairly valued that with one surprise, a negative surprise, they will make my buy list. I will not tempt fate and try to sell short on Amazon because, it's not a stock where people do well when they sell short. So when I look at Amazon, I will continue to track the stock. And the other thing that worries me with Amazon in terms of selling short is I don't see a catalyst that will cause the price to adjust to value. So again, let me be very clear. I'm not trying to send any indications out there as to what you should do. In fact, when you think of my Apple sale, think about my record with Tesla. I sold Tesla in January at $640. You know what Tesla is trading at today? $2,000. Not a great track record, right? So from that perspective, remember, I might be selling too soon, but I have to make the decisions that make the most sense for me. So I hope you found this session useful, but I think these 6 stocks have dominated so much of market discussion over the last 10 years. It's well worth the time we spent on it today. Thank you very much.